Mortgage Insurance 101. So real briefly, I'm going to get into this video and I'm just going to give you guys some basic information about mortgage insurance, the different types, and what factors affect it. So first, I want to go for and talk about its main purpose. And also the main purpose of mortgage insurance is that it lowers the risk of the lender making the loan out to you. It's mostly there to protect the lender in case you default or you foreclose on your home. But the flip side of that, and I guess the brighter side is the way I would want to think about it, is that it helps you and gives you the ability to qualify for a loan that you may otherwise not be able to get. So for a second, imagine that mortgage insurance is not a thing. You don't have to pay it. Lenders would feel that loans with less than a 20% down payment for a conventional loan program, of course, are too risky to lend out. So they would basically mandate that you have to have a 20% down payment in order to get a loan for the rest of the amount. Now, the people that have a 5 and 10 or 15% payment that may qualify, they have a strong monthly payment, but just have to wait, however many years it takes to save up and get to that 20% down payment. So if you are looking to buy at 5 or 10% down, then it's really a tool that helps you be able to do that. And factors that affect private mortgage insurance, there are basically three main factors, and they're not in any particular order, but one is credit score. The better your score, the less you'll have to pay. Number two, down payment percentage, same thing. The closer you are to that 20% down payment mark, the less you'll have to pay in mortgage insurance. And three, that's an income ratio. So you definitely consider that when calculating what you'll pay in mortgage insurance. So make sure those are favorable. And three main types of mortgage insurance. One, which is the most common, monthly. This is what you pay on every month if you're below 20% down on a conventional loan program. Number two, single premium. Not as common, but some people like this better. You just pay an upfront fee, and that gets rid of your monthly mortgage insurance. So better from a monthly standpoint, but again, it's going to be more expensive up front. And then number three, split or buy down. This is just a combination of one and two. You pay an upfront fee, and then you pay monthly as well. The idea is that usually the upfront fee is smaller than what it would be in a single premium, and your monthly fee would be smaller than what it would be in a normal all monthly mortgage insurance payment. So I have some examples that I want to show, and this will actually break up the three different options I gave you. First one is monthly PMI. And before I continue, I forgot to mention, this is just hypothetical again. This is just to give you an idea of what the different types are. If you want your own specific customized total cost analysis like you're seeing here, then just reach out and let me know in any way that you can, and I'd be more than happy to set something up for you. So again, let's say we're looking at a $750,000 purchase price, and the down payment here is 5% down. So you'll see your loan amount here about $712, and the rates follow there. And then here are our payments respectively for each category. We're going to look at monthly, single premium, and then a split or buy down. So one thing I want to know, which we'll come back to later, is the cash to close. You can see that the monthly cash to close is lower than the other two options, and there's a good reason why. But I'm going to open up this payment breakdown tab, which again, we've gone over something like this before, but you'll see your principal and interest, property taxes, homeowner's insurance, and then your mortgage insurance. So like I mentioned, the highest mortgage insurance payment is in the strictly monthly PMI option. And then the lowest is actually at $0 for the single premium because, again, you're paying it off up front. That way you don't have to pay monthly. Next best option is $29.69. That's the split or buy down option. So this one, again, you'll pay a little bit up front and you'll still pay a smaller percentage month to month there. So you can see, obviously, in the month to month perspective, single premium is the best. But like I mentioned, the cash to close here is where that comes in. You pay more, which here I'm showing about $7,000 more to get rid of that monthly mortgage insurance payment. So it really depends on your preference and what you like to do. Sometimes though, if it's just a matter of qualifying based on debt to income, then you might want to go for the single premium. But again, we can talk about that more later. So I'll show you here on the split buy down, you're going to be paying a 1% premium and then whatever the monthly fee is. So that's just the way that they decided they're going to split it up. And for single premium, that will vary. So again, this one's just a straight up single premium, no monthly included. In this specific case I'm showing you, it's actually better just to do the single premium because in this option you're only paying, it looks like $6,700, which is a little bit less than 1% of what you're paying here. And then in the split buy down option, if I open that up, the mortgage insurance premium there is 1%, which is about $7,100. So in this case, it wouldn't really make sense to do a split buy down. You would just stick with the single premium. But again, it's going to vary, and you want to make sure that you get an accurate quote for your needs. This is all just hypothetical for your own education and entertainment. All right, so if you have any other questions or you want to see any other scenarios, please comment below. As always, like and subscribe. And yeah, that'll be all. Thank you, folks.